the end of the week, investors still hope that the Fed may continue with the rate hikes. During his regular speech, Fed Chairman Jerome Powell unexpectedly admitted that he was not sure if the central bank had taken enough measures to curb inflation. In addition, strong data on the US economy allows the regulator to take another step to tighten monetary policy. In general, such rhetoric brought back demand for the US dollar. In our review, we will cover other important economic news scheduled for the next trading week. The next trading week will offer us a lot of economic releases. This flow of important macroeconomic data will begin on Tuesday with the UK's CLAIMANT count change report. According to forecast, the unemployment rate for September will rise to 4.4%. The indicator is likely to continue to increase in the near future, as the number of unemployed claims in October is expected to rise. This is unfavorable for the British currency's investment appeal. Meanwhile, the Bank of England is unlikely to raise the interest rate in such conditions. Also, among the news from Europe will be a report on the business sentiment in Germany. The November reading may continue to rise and even break above zero. Notably, the index has been in the negative zone for 6 months. If the forecasts are confirmed, it will be the best performance since March. The improvement in sentiment is mainly due to the assumption that the European Central Bank will not raise interest rates. In addition, investors even consider the timing of its reduction. Therefore, the euro-dollar pair is likely to soar in the short term. Next week, all eyes will be on the US inflation report. Investors will return to the US Central Bank's interest rates. Most likely, the reaction to this news will be the opposite, and the US dollar will be under bearish pressure. Analysts are confident that the growth rate of consumer prices in October will slow down to 3.3%, and this will be a clear signal to the Fed to refrain from a tightening monetary policy and continue monitoring the country's economic conditions. By the way, the Governing Council of the Bank of Japan has been in a wait-and-see mode for quite some time. They are not raising the interest rate, keeping it at a -0.1% to support the national economy. Most likely, this strategy will be questioned because inflation is still above the target of 2% per year. However, the rate of economic growth may be in the recession zone in the third quarter, according to forecast. It's unlikely that this news will cause the monetary authorities to raise interest rates. Against this backdrop, the yen may face another sell-off. On Wednesday, the next batch of China statistics will also be important. Investors will assess the outlook for the global economy. The world's major exporter of consumer goods is likely to report on the continued slowdown of global economic growth. China's industrial production is unable to gain momentum in the face of a weak foreign demand. The report is likely to show growth slowing to 4.3%. The news may add to risk-aversion sentiment, putting more pressure on the Australian dollar as a risk barometer in the Asia-Pacific session. Let's get back to the Bank of England interest rates. In the beginning, I said that the Bank of England is unlikely to raise interest rates amid a weak labour market. On a Wednesday, investors will continue to assess the regulator's monetary policy after the fresh inflation data is released. They are expecting a sharp slowdown in consumer prices up to 4.8%, as in the Eurozone. And this will signal the Bank of England to make a rate hike. As a result, the British pound is highly likely to experience a sell-off next week. And we will monitor the market reaction to the above-mentioned reports. Subscribe to our channel and follow changes in market sentiment with us. Any comments, questions and offers are welcomed. We wish you profitable trading and see you soon.